This reporting period witnessed falls in major equity markets in sterling terms, whilst fixed interest markets rose in value. Despite the recent falls, all major asset classes have recorded strong gains so far in 2019. Looking at the notable investment association sectors over this quarter, North America provided the lowest return of -5.43%. These returns were significantly influenced by around a 6% rise in sterling during the period, reducing the value of dollar assets. The UK all-companies sector was one of the strongest performing equity sectors, returning -0.99%, followed by Europe. The sterling corporate bonds and UK gilt sectors returned 1.29% and 2.58% respectively. Brexit continues to dominate domestic politics, with Boris Johnson failing to meet his do-or-die deadline of October the 31st. Parliament passed the Benn Act, compelling the Prime Minister to seek an extension if a deal had not been agreed, which prevented the UK from leaving without a deal. However, markets were surprised that the withdrawal agreement had been reopened and a replacement to the Northern Irish backstop arrangements agreed, despite the EU previously insisting it would not renegotiate. Parliament voted in favour of the bill, but Boris felt it would not successfully pass a final reading due to the likely amendments which would, in his view, not sustain a majority. He claimed that Parliament was broken and that an election was necessary for the people to decide which party should manage Brexit going forward. Johnson eventually forced Parliament to agree to an election, with the date set for December the 12th. This election is now being cast as a second referendum, with all the main parties taking a clear and distinct stance on Brexit. The Conservatives are promising to complete Brexit with a deal ready to be executed immediately, and they are currently leading in the polls by around 10%. The performance of the various market indices during this reporting period gives an important indication about how markets may react in each of the various Brexit outcomes. As news broke that a new deal had been reached, sterling appreciated in value, reducing the value of overseas assets. UK stocks rose in value, particularly domestic-focused businesses, with the FTSE 250 index rising by more than 4% in one day. In the event of a Conservative majority, we expect a similar market reaction, as UK equities have been avoided by many international investors due to uncertainty. A clear path for Brexit would encourage more investment into both sterling and UK stocks. A Labour majority would also remove the option of a no-deal Brexit, but investors may be concerned by certain Labour policies, such as a nationalisation of key industries from private investors. This is essentially a Christmas election, and the main parties have fully embraced the festive season with huge infrastructure spending promises. The governments of many developed economies are making similar promises, as spending increases will be popular with voters. It will provide a boost to flagging economic growth and potentially stoke inflationary pressures. The main shadow over the global economy has been the escalation in trade tensions between the US and China, which has led to tariffs on goods traded between the world's two largest economies. This has caused a reduction in trade and confidence, which explains the drop in global growth. Although a resolution of these tensions has seemed tantalizingly close on several occasions, the breakthrough has not yet occurred. Looking forward, the combined global effect of increased government spending and a reduction in trade tensions should support positive returns for equity markets. Although we have felt that fixed interest markets have been unattractive for some time, our view remains unchanged. If governments issue more debt whilst increasing spending, this may push yields up, which lead to losses for fixed interest assets. If a breakthrough does occur in the trade negotiations and Conservatives secure a majority at the next election, we are likely to benefit from our current positioning, extending the recent trend of returns above benchmark. A full PDF commentary of this quarter is available on the Margetts website. Margetts Fund Management, specialising in managing risk-rated multi-manager funds.